stage belongs to central banks in the coming week, at least from a macroeconomic point of view, with policy decisions due from the US Federal Reserve, the Bank of Japan and the Bank of England. The Federal Reserve will be first up on Wednesday the 19th of June. As we've discussed in a few of these videos recently, the American Monetary Authority has completely changed its tune this year. At Christmas time, Chair Jay Powell was hinting at a regular sequence of interest rate increases to add to the 4 seen in 2018 and a total of 9 1/4 point hikes since late 2015. However, Mr. Powell and his colleagues have now become much more dovish, citing their concerns about the damage that the ongoing trade dispute with China could have upon the American and indeed the global economy. The Fed may have also been taken aback by the fourth quarter rout in global stock and bond markets as it gradually tightened monetary policy. According to the CME FedWatch service, which you can look for free on the internet, markets are only putting an 18% chance on a rate cut from the current 2.5% at this meeting, but there seems to be a 98% chance of at least one cut by December, an 80% chance of 2, and nearly a 50% chance of 3 or more. In theory, lower rates will lower returns on cash, drag down bond yields and drive money into equities, but it doesn't always work like this. Fed cuts did not stop stock market collapses in 2000 to 2003 and 2007 to 9 because the economy and corporate earnings tanked at the same time. On Thursday the 20th, we'll then get the latest from the Bank of Japan and the Bank of England. Neither is expected to do anything, with the Bank of Japan leaving its headline rate at minus 0.1% and the Bank of England holding firm at 0.75%. But economists will listen carefully to any comments from Governors Haruhiko Kuroda and Mark Carney respectively. Both seem more likely to be dovish than hawkish, and attention may focus much more on their commentary on other tools rather than interest rates. The Bank of Japan is still running its quantitative easing policy flat out at 80 trillion yen a year, although the Bank of England has not added to its £445 billion scheme for some time. Remember that the Bank of Japan in particular has got plenty to think about, but notably the possible effect upon the Japanese economy of a planned increase in consumption tax to 10% from 8% this autumn. Meanwhile, the Bank of England, well, that's still wrestling with the possible implications of Brexit above and beyond wider global trade and growth worries. Company-wise, a handful of FTSE 100 firms are due to release an update, issue results or host an annual general meeting this week. We've also got a select number of mid and small caps who will be updating their shareholders. Possible highlights from the calendar are as follows. On Tuesday the 18th of June, multi-utility Telecom Plus will publish full year results and Tesco will host a capital markets day for analysts. On the 19th, we'll see results from high-end house builder Barclay and trading statements from both Whitbread and Saga. And then finally, on Thursday the 20th, retailer Dixon's Carphone will publish full year results and another retailer, N Brown, will unveil a trading update. But for me, the stock most likely to cause a big fuss in the week ahead is Ashtead. The equipment rental giant is due to report its full year figures on Tuesday the 18th of June, and this is the first set of results from the company since Brendan Horgan took over as chief executive on the 1st of May, following Jeff Drabble's decision to step down after 12.5 years at the helm. As we can see here, the shares have rather ground to a halt of late. In fact, they've shed a fifth of their value since they reached an all-time high just around the £24 a share mark last October. The company gets around 90% of its sales and profits from America via its Sunbelt subsidiary, with the bulk of the rest coming from the UK-based A-Plant business, so there may be a few reasons why the shares have sagged slightly. First, investors have become, rather like the Federal Reserve, more concerned over the global growth outlook in light of the ongoing trade dispute between China and America. Second, economic news flow from the States has become increasingly spotty. Housing data and car sales have looked quite weak of late, and we've seen mixed reports from other UK-listed firms that are very active in America, notably plumbers merchant Ferguson, for example. An awfully wet spring stateside has not helped, but we can see how the Institute for Supply Management's Purchasing Managers Index, or PMI, for American manufacturers has shown lower levels of activity recently. And we can also see how Ashtead shares have responded to that. Finally, investors, well, they have to ponder the health of the UK economy in its pre-Brexit state as well. The manufacturing PMI here sagged of late as well, although activity readings on this still do not warn of a slowdown or recession as yet, as they're coming in above 50, but growth outlook does look rather moderate. So, when it comes to Ashtead's numbers, analysts will be looking at 3 headline figures. The first is sales. On a stated basis, Ashtead has been generating percentage sales growth pretty consistently in the mid to high teens for some time. Analysts are looking for a full year sales figure of around £4.4 billion against 3.7 a year ago, a rate of increase of just under 20%. Also note that Ashtead will release a number which adjusts for foreign currency movements. The second figure to watch, well, that's pre-tax profit. Again, percentage growth has been running consistently in the teens, with the exception of the fourth quarter of last year when bad weather took a turn. For the whole year to the end of April, analysts are looking for a stated pre-tax profit of just over £1 billion against £862 million a year ago. Just as importantly, the consensus is for a 20% jump to just over £1.2 billion in the year just begun, so look out for any guidance or forecasts from Mr. Horgan and his management team. There'll be 3 littler items to watch, by the way. The ongoing share buyback programme, spend on bolt-on acquisitions, which had reached £491 million at the 9-month stage, and particularly capital investment. If management is feeling bullish, it may well buy more kit to rent out. At the third quarter stage, capital investment was up 50% year on year to £1.3 billion. That meant that Ashtead had already exceeded last year's £1.24 billion investment, but watch out for any changes in the rate of growth as a means of judging management's outlook on trading. Finally, the third and final big number to watch, well, that would be the dividend. Last year, Ashtead distributed 33p a share to shareholders, and analysts are looking for an 11% increase to 37.8p. That would extend an impressive streak of increases in the annual dividend that dates back to 2005, and analysts think the run will continue in the latest financial year for good measure. Thank you for watching, and I look forward to seeing you next time.